Okay, wow. There's just so much information flying around these days, isn't there?
It really is overwhelming sometimes.
Yeah, and trying to cut through that noise, especially with financial stuff, it's tough. You've probably seen financial statements marked as reviewed and thought, okay, cool, someone checked these.
Right, but what does reviewed actually mean? It's a common point of confusion. Is it like an audit or just a quick look?
Exactly. So today, that's our mission. We're diving deep to really understand a critical but often misunderstood piece of the financial puzzle, the review report.
That's right. We're drawing on some really detailed material that gets into the nitty-gritty of review engagements and these reports. Our goal here is to break it all down for you.
So whether you're decoding financial statements for your job, making investment decisions, or maybe you're just curious about how company finances work, this deep dive is definitely for you.
Think of these reports as providing a certain level of comfort, but it's crucial to know exactly what that comfort entails.
We'll equip you with those precise insights, making the complex bits, hopefully, pretty easy to grasp.
Yeah.
Okay, ready to jump in.
Let's do it.
So let's start at the very beginning, the foundation. Independence. Why is it so non-negotiable for an accountant doing a review?
Oh, it's absolutely fundamental. It's all about objectivity. You, as the user of the report, need to trust that the accountant isn't biased.
Makes sense.
So an accountant has to be independent of the client to even issue a review report. And if anything happens during the engagement that compromises that independence, well, they have to withdraw.
No choice.
No choice at all. It's not optional. It's a core requirement. Without it, the report loses its credibility.
Got it. Independence is job one. So once that's established, how does the accountant actually, arrive at their conclusion? What are they looking at?
It's a pretty comprehensive evaluation process. They're essentially checking if the financial statements make sense as a whole based on the rule.
What kind of checks?
Well, first, they look at the financial reporting framework, like GAAP, for instance. Does the report properly refer to it? Is it described adequately?
So are they speaking the right financial language, basically?
Exactly. And are they using the right terminology? Are the titles on the statements appropriate according to that framework? Then they dig a bit deeper.
Yeah.
Are the significant accounting policies disclosed properly? Are they consistent? Are management's estimates, and this is a big one, are they reasonable?
Estimates can be tricky.
They really can be. The accountant also assesses if the information presented is relevant, reliable, comparable, and understandable. Does it actually help the user?
Right.
And crucially, do the disclosures give you enough information to understand the impact of any significant transactions or events?
So you can see what really happened.
Precisely. They also consider the effect of any misstatements that haven't been corrected and look at the qualitative aspects of the company's accounting practices.
Qualitative, like the judgment calls.
Yeah, the choices management made. And finally, they look at the overall presentation, structure, and content. Do the statements fairly reflect the underlying transactions?
It really sounds like looking at the whole picture, making sure it all hangs together logically.
That's a great way to put it.
So how do all these checks, this whole process, lead to the actual conclusion in the report? What are the potential outcomes?
Right, that brings us to the different types of conclusions you might see. The best case scenario, if you will, is what's called an unmodified conclusion.
The clean bill of health.
Kind of, yeah. But it's important to understand what it means. It means the accountant has obtained limited assurance. That's the key phrase.
Limited assurance.
But based on their review procedures, nothing has come to their attention that makes them believe the financial statements are not prepared in all material respects, according to the applicable financial reporting framework.
Okay, limited assurance. That sounds, limited. You highlighted its key. Why? What's the big deal about that phrase?
It is a huge deal because it's fundamentally different from an audit. An audit provides reasonable assurance, which is a high level, allowing the auditor to give an opinion.
An opinion like, yes, these are fair.
Exactly. A review, however, provides only limited assurance. The procedures are much narrower. Think analytical procedures, inquiries. It's substantially less in scope than an audit.
So they're not digging into every single transaction like an auditor would.
No, not at all. They're looking for things that seem unusual or implausible based on their understanding and analysis, but they're not verifying everything. That's why the report explicitly states they don't express an opinion.
That distinction is vital, so it's assurance, but not a guarantee. Good for companies wanting credibility without a full audit, maybe.
Precisely. It fills an important gap. Understanding that scope is crucial for anyone using these reports.
Okay, that makes sense.
Well,
Let's actually walk through a standard report. The sample you mentioned, Independent Accountants Review Report, what are the key sections?
okay, let's break it down. It starts with the addressee. Who is this report actually for? Could be the board, shareholders, management.
Straightforward enough.
Then comes the introductory paragraph.
Yeah.
It starts with, "We have reviewed," and clearly lists the financial statements covered, balance sheet, income statement, cash flows, notes to the financials, the whole set for a specific period.
Specifying exactly what they looked at.
Yes. And, crucially, it describes the scope. A review includes primarily applying analytical procedures to management's financial data and making inquiries of company management.
Setting expectations right away.
But then comes that vital distinction we just talked about. The report usually quotes something like, "A review is substantially less in scope than an audit. Accordingly, we do not express such an opinion."
They really hammer that point home. No audit opinion here.
They have to. It's critical for managing expectations. Next is management's responsibility.
Clarifying who owns the numbers.
Exactly. It states clearly that management is responsible for preparing the financial statements fairly, according to the framework, and for designing and maintaining internal controls.
So the buck stops with management for the actual statements.
Yes. Then you have the accountant's responsibility paragraph. This outlines their role. Conducting the review according to professional standards in the U.S., that's typically AICPA standards, to obtain that limited assurance.
Limited assurance again. There it is.
It's the core concept. And finally, you get to the accountant's conclusion. For an unmodified report, this is the key sentence. Based on our review, we are not aware of any material modifications that should be made to the financial statements for them to be in line with the reporting framework, like GAAP.
That's the sentence everyone looks for. The green light, essentially, where the rubber meets the road.
That's the one.
But what if the accountant does become aware of material modifications needed? What if things aren't so clean?
Yes. That leads to what's called a modified conclusion. This happens when the accountant finds misstatements that are material.
Material meaning big enough to potentially influence a user's decision.
Exactly. And there are two main types of modified conclusions, depending on how widespread the issue is.
Okay.
If the effect of the misstatement is material but not pervasive, meaning it's significant but doesn't fundamentally undermine the statements as a whole, the accountant issues a qualified conclusion.
So like a specific problem area, but the rest is okay. Like that leaky faucet example we mentioned.
That's a good analogy, yes.
Yeah.
But if the effect of the misstatement is both material and pervasive, meaning it's so significant it affects numerous items, or fundamentally misrepresents the financial position, then it's an adverse conclusion.
That sounds much more serious, like the whole plumbing system is shot.
It is. An adverse conclusion is basically saying the financial statements, taken as a whole, are not presented fairly according to the framework. It's a major red flag.
Okay, pervasive is the key difference there. Could you show us how these look in the report? Let's start with the qualified one.
Sure. For a qualified conclusion, the report structure changes slightly. You'll see a heading that clearly says qualified conclusion. And right before that conclusion paragraph, there's a crucial section called Basis for Qualified Conclusion.
Explaining the why.
Precisely. It details the specific matter causing the qualification. For instance, our sample text gives an example related to inventory costing.
What was the issue there?
The company stated its inventory using only material and labor costs, but GAAP requires including factory overhead as well. The basis paragraph explains this departure from GAAP and crucially notes that the effects of this departure on the financial statements haven't been determined by management.
So they know it's wrong, but not exactly how much it skewed the numbers?
Right. And then the qualified conclusion paragraph itself will read something like, based on our review, except for the effect of the matter described in the basis for qualified conclusion paragraph, we are not aware of any material modifications.
The except for phrase, that's the key takeaway for the listener, right? That
Yeah.
flags the specific problem.
Exactly. It isolates the issue while indicating the rest appears okay under the limited assurance scope.
Okay, now for the really serious one. The adverse conclusion. How does that look?
Structurally similar, but the message is much stronger. You'll have an adverse conclusion heading and a basis for adverse conclusion section right before it.
Detailing the pervasive problem.
Yes. The sample text provides an example where a company failed to consolidate a subsidiary controlled.
Yeah.
Management didn't do it because they hadn't figured out the fair values of the subsidiary's assets and liabilities.
But under GAAP, they should have consolidated.
Absolutely. If you control it, you generally consolidate it under GAAP. The basis paragraph explains this failure and states that if the subsidiary had been consolidated, many elements in the accompanying consolidated financial statements would have been materially affected.
Wow. So it impacts potentially lots of numbers.
Very likely, yes. That's the pervasiveness. And then the adverse conclusion paragraph is blunt. It says something like, based on our review, due to the significance of the matter described in the basis for adverse conclusion paragraph, the financial statements are not presented in accordance with accounting principles generally accepted in the United States of America.
No mincing words there. It basically says the statements are fundamentally flawed according to the rules.
Correct. It's the most severe conclusion an accountant can issue in a review. It tells you the financials, as presented, are unreliable.
Okay, that's very clear. Now, beyond the main conclusion, modified or unmodified accountants can sometimes add extra paragraphs, right? To draw attention to specific things.
Yes, exactly. There are two main types: emphasis of matter, EOM paragraphs, and other matter paragraphs.
Emphasis of matter. Sounds like they're underlining something important.
That's a good way to think about it. An EOM paragraph draws the user's attention to a matter that is already properly presented or disclosed within the financial statements, but the accountant thinks it's fundamental to the user's understanding.
So it's not a qualification, just a, hey, look closely at this note.
Precisely. It doesn't modify the conclusion.
Yeah.
It's required in certain situations, like substantial doubt about going concern, which we'll get to, or if the financials are based on a special purpose framework instead of GAAP.
Okay.
It can also be used at the accountant's discretion for things already disclosed in the notes, like significant related party transactions, a major catastrophe that happened after the balance sheet date but before the report, or maybe unusually important litigation.
Things you definitely want to know about. The past key examples you mentioned, litigation, catastrophe, related parties, subsequent events, those make sense.
Right. The key is that the information is already in the financials or notes. The EOM paragraph just highlights it.
And the other matter paragraph, how's that different?
An other matter paragraph refers to something not presented or disclosed in the financial statements, but the accountant believes it's relevant to the user's understanding of the review, the accountant's responsibilities, or the report itself.
So information outside the financials, but still important context.
Exactly. For example, it might be used if the report is restricted to certain users, or when discussing comparative statements where prior periods had different levels of service. And importantly, the accountant needs to communicate with management if they plan to include either an EOM or an other matter paragraph.
Good communication practice. Now, you mentioned special purpose frameworks. What if the financials aren't using GAAP? Maybe for a specific industry regulator or something.
That happens. When statements are prepared under a special purpose framework, could be cash basis, tax basis, regulatory basis, contractual basis, the review report needs to reflect that clearly.
How so?
Well, management's responsibility paragraph will mention their responsibility for determining the framework is acceptable. And then critically, an emphasis of matter paragraph is required.
What does that EOM paragraph say?
It explicitly states the framework used, example, cash basis, refers the reader to the note in the financials that describes it, and clearly states that this framework is a basis of accounting other than accounting principles generally accepted in the United States of America.
So no confusion. You know you're not looking at standard GAAP financials.
Correct. And if it's a regulatory or contractual basis, there's usually an additional required other matter paragraph that restricts the use of the report only to those who understand that specific framework, like the regulator or the parties to the contract.
Preventing misuse by people unfamiliar with the special rules.
Exactly. And the report would need to be modified, likely qualified or adverse, if the financials don't properly describe the framework, summarize the accounting policies, explain how it differs from GAAP, or lack informative disclosures similar to GAAP.
Makes sense. Okay, what about big companies where maybe different accounting firms review different parts, like subsidiaries? How's that handled?
That's common. If the main accountant, the one signing the overall report, decides not to take responsibility for the work done by another accountant on a subsidiary or division, they can make reference to that other accountant in their report.
You don't have to, but they can.
Right, it's their choice. If they do, they'll typically mention it in the accountant's responsibility paragraph, indicating the size or portion of the financials reviewed by the other firm. This is only possible if the other accountant's report isn't restricted in its use.
So it signals part of this work was done by someone else, and I'm relying on their findings for that piece.
Essentially, yes. It provides transparency about who did what.
Now, a really big one for users, going concern. Can this company keep operating? How does a review address that?
This is hugely important. Is the company likely to be around in, say, the next year? Accountants performing a review need to consider this. If the accounting framework requires management to evaluate going concern, or if conditions arise during the review that raise doubts, the accountant performs procedures. They'll look at management's assessment, inquire about their plans to deal with the issues, like getting new financing, selling assets, cutting costs, and evaluate whether the financial statement disclosures about the situation are adequate.
Okay, so they investigate the doubt. What happens then in the report?
It depends. If the procedures make the accountant believe that management's plans alleviate the substantial doubt, they may include an emphasis of matter paragraph discussing the situation, but it's optional. The conclusion remains unmodified.
But what if the doubt isn't alleviated? What if it looks like there's a real risk?
If substantial doubt still exists after reviewing management's plans, the accountant must include a separate section in the report. It will have a heading like substantial doubt about the entity's ability to continue as a going concern.
A very clear warning sign.
Yes. This section draws the reader's attention to the note in the financial statements where management discusses the conditions and their plans. Importantly, the existence of this doubt in this paragraph doesn't by itself modify the accountant's conclusion on the financials.
So the conclusion could still be unmodified, but with this huge flag waving.
Correct. The flag points you to the disclosures. However, if the accountant finds that the disclosures about the going concern issue are inadequate, if management isn't being transparent enough in the notes, then the accountant would issue a qualified or adverse conclusion.
That makes sense. The reporting itself has to be adequate. This is so critical for anyone trying to gauge a company's stability.
Absolutely. It's one of the most forward-looking pieces of information you can get from these reports.
Okay, let's shift gears slightly. Companies often show financials for several years, side-by-side comparative statements. How do review reports handle that, especially if maybe last year was only compiled, but this year was reviewed?
That's a very common scenario. The basic rule is the accountant's report has to cover each period presented. If the same accountant did the work for all periods presented, a continuing accountant, they need to update their report on the prior periods based on any new information they've learned since then.
So they look back with fresh eyes.
In a sense, yes. Now, if the level of service changes, the report needs to be very clear about that. Let's take your example. Current year reviewed, prior year compiled. That's moving to a higher level of service.
Right.
In that case, the report on the prior period, the compilation report, should be updated and included, usually as the last paragraph of the current year's review report. It clarifies the lower level of service applied to those prior numbers.
So you know the history. What about the other way? Current year compiled, prior year reviewed, a lower level of service now.
Good question. The accountant has two main options there. One, issue a compilation report on the current period and add a separate paragraph to that report describing the responsibility they took for the prior period's review. This paragraph would mention the date of the original review report and state clearly that they haven't performed any review procedures since that date.
Option one report, extra paragraph.
Right. Option two is to reissue the prior period's review report. This could be combined with the current compilation report or presented separately. If combined, they need to state that no review procedures were performed after the date of that original review report.
So either way, it's crystal clear what service applied to which year. It's like you said, knowing if you're comparing an apple to an apple or an apple to a pear.
Exactly. Transparency about the level of assurance for each period is paramount. You also have to be careful if one period's statements are presented in columnar form next to another. If one set is, say, unreviewed and the other is compiled, the unreviewed ones need to be clearly marked so no one mistakenly thinks the compilation report covers them.
Makes sense. Avoid confusion.
And importantly, an accountant can't issue a report on comparative statements if one or more of the periods substantially omits required disclosures under GAAP. They just aren't comparable at that point.
Got it. What if new information comes up that affects a previous report? Like they discover an error from last year?
If information comes to light that would have changed a prior report, maybe requiring a modification that wasn't made, or removing one that was the accountant, should add an other matter paragraph to the report referring to the prior period.
What would that paragraph say?
It would state the date of the original report, whether the financial statements from that period have been changed, and the reason for the change in the report. Again, it's about updating the record.
Okay, and what if it was a different accountant who handled the prior year? A predecessor?
That happens frequently with company growth or changes. The predecessor accountant can reissue the report on the prior period statements.
Can. So they don't have to.
Correct. If they choose to, they need to do some homework first. They should read the current period statements, compare the prior ones they reported on with how they're presented now, and get a representation letter from the new accountant, the successor, saying they aren't aware of anything that materially affects the prior statements.
Due diligence to make sure their old report is still valid.
Exactly.
Yeah.
Now, if the predecessor doesn't reissue their report, the current accountant isn't required to reference the predecessor's work, but they can choose to.
How would they do that?
They would add an other matter paragraph to their current report. This paragraph would state that the prior period statements were handled by other accountants. They usually aren't named the date of the predecessor's report, the type of service performed, review or compilation, and any modifications they made.
Providing context about the prior period's assurance level.
Precisely. And if the prior period statements have been restated, either the predecessor or the successor can report on them, or the successor can report just on the restatement adjustment itself. Lots of options, but the goal is always clarity for the user.
This definitely comes up a lot, especially as companies grow and maybe go for an audit for the first time. How do reports handle mixing audited and unaudited periods?
Great point. When unaudited statements, compiled or reviewed, are presented comparatively with audited statements, those unaudited statements must be clearly marked as unaudited.
Big letters, unaudited.
You got it. Then, the accountant's report needs to address this. They'll either reissue the prior period's compilation or review report, or, more commonly, they'll add an other matter paragraph to the current period's report describing the situation.
Can you give specifics on those other matter paragraphs? Say, current year is unaudited, prior was audited.
Sure. If the current period is compiled or reviewed, unaudited, and the prior periods was audited, the current accountant's report includes an other matter paragraph. It states, the prior statements were audited, the date of the audit report, the type of opinion expressed, and reasons if it was modified, and crucially, that no auditing procedures have been performed since that prior report date.
Very clear boundary on the audit work.
Yes. Now, flip it. Current year is audited, prior year was unaudited, reviewed, or compiled. The current year auditor's report will include an other matter paragraph stating the type of service performed in the prior period, review or compilation, the date of that prior report, any modifications included in it, and this is key, a statement that the service was less in scope than an audit and did not provide the basis for an opinion.
Reinforcing that difference in assurance level, you mentioned a small exception for SEC filings.
Ah, yes. Just a quick note. If unaudited financials are included in an SEC filing alongside audited ones, they still need to be marked unaudited. But typically the auditor's report doesn't refer to them in another matter paragraph. It's a specific SEC convention.
Good nuance to know. Wow, that covers a lot of ground on comparisons. To wrap this section up, can you quickly remind us of that passkey comparison between compilation, review, and audit, just to solidify the differences?
Absolutely. It's a helpful way to visualize the increasing levels of work and assurance. A compilation. The accountant basically takes management's data and puts it into financial statement format. They issue a report, but perform no assurance procedures. They're not checking the numbers.
Just assembling the information.
Right. A review steps it up, creates the report, plus the accountant makes inquiries of management and performs analytical procedures, like comparing trends and ratios. This provides that limited assurance.
Looking for things that seem off.
Exactly. An audit includes everything a review does, but goes much, much deeper. Detailed testing of transactions and balances, evaluating internal controls, all to gather enough evidence to express an opinion with reasonable assurance.
The highest level of assurance among the three, that comparison really helps clarify the landscape.
It provides a good framework.
Okay, so let's quickly recap. We've unpacked what a review report actually is, why independence is so critical, and the different conclusions unmodified, qualified, adverse, and what signals they send.
And we've looked at how emphasis of matter and other matter paragraphs add important context, how special purpose frameworks are handled, and the complexities of reporting ongoing concern doubts.
Plus, navigating those comparative statements when levels of service change or different accountants are involved.
Phew,
Yeah.
a lot, but crucial details.
Absolutely. So now, you, the listener, are hopefully feeling much more confident when you encounter a review report. You know what limited assurance really signifies? You can spot the red flags and modified conclusions, and you understand the structure and language.
You're not just looking at a document anymore. You can interpret its story and, importantly, its limitations.
You're equipped to understand the nuances, ask better questions, and really see what the accountant is and isn't saying. It's like having that decoder ring we talked about.
It empowers you to better assess a company's financial transparency.
Definitely. So here's a final thought to leave you with. Considering how review reports offer this middle ground of assurance, this limited check without the full cost of an audit, how does understanding the precise meaning behind that limited assurance and the specific wording of the report change how you might perceive a company's commitment to transparency and the responsibility they ultimately bear for their own financial story?
Something to think about next time you see one.
Keep digging, keep questioning.